According to the ICC's 2024 Global Survey on Trade Finance, roughly 40% of European trade finance banks now include ESG scoring as a formal criterion in deal approval. 2 years ago, that number was in single digits. That means deals are getting killed, not because of credit risk, not because of fraud, but because the borrower's supply chain ESG score is too low. Clean financials, dirty supply chain, deal declined. If you think this doesn't affect your portfolio yet, you're not paying attention to what's happening in trade finance right now. Let me set the stage. Because this shift didn't happen overnight, but most trade finance teams are acting like it hasn't happened at all. The EU Taxonomy regulation went into effect and fundamentally changed how European financial institutions classify economic activities. It created a framework for determining whether an activity is environmentally sustainable. And that classification now directly impacts lending decisions, investment allocation, and this is the key part, trade finance approvals. On top of that, the Corporate Sustainability Reporting Directive, CSRD, expanded mandatory ESG disclosure requirements to over 50,000 companies operating in or with the European Union. That means your borrowers, their suppliers, and their suppliers are now subject to sustainability reporting obligations that feed directly into how banks assess risk. This isn't CSR anymore. This isn't a page in the annual report with a picture of a tree. ESG risk is on the credit committee's agenda. It's in the risk appetite framework. It's part of the deal approval checklist. And here's a stat that should get your attention. According to the International Chamber of Commerce's 2024 Global Survey on Trade Finance, roughly 40% of European trade finance banks now include ESG scoring as a formal criterion in deal approval. Not we are thinking about it, not we have a working group. 40% are already scoring ESG and using it to approve or decline facilities. 2 years ago, that number was in single digits. The trajectory is unmistakable. And for those of you thinking, well, that's Europe, doesn't affect us, let me be direct. If your borrowers sell to European buyers, if your supply chains touch EU jurisdictions, if your counterparties bank with European institutions, it already affects you. ESG compliance travels through supply chains. It doesn't stop at borders. So let's talk about what this actually means for trade finance teams on the ground, because the implications are more concrete than most people realize. Here's the chain of risk, and I want you to follow it carefully. Supplier ESG risk is borrower risk. Borrower risk is portfolio risk. It's a cascade. A borrower can have pristine financials, strong revenue, low leverage, solid payment history. But if their supply chain is carbon intensive, if their sourcing relies on deforestation-linked commodities, that borrower is now classified as high risk under the new frameworks. Clean financials, dirty supply chain, high risk. That's the new math. And it's showing up in real deal flow right now. Letters of credit are being declined based on sustainability criteria. Pre-export financing is getting held up because the bank can't verify the supplier's environmental practices. Commodity trade finance, which has always been relationship-driven, is now subject to ESG screening that can kill a deal in the early stages. The pricing implications are significant too. Carbon-intensive supply chains are facing higher financing costs across the board. The European Banking Authority's guidelines on ESG risk management explicitly link sustainability risk to credit risk pricing. Banks that extend trade finance to high ESG risk borrowers face higher capital requirements, which means they either charge more or decline the deal entirely. I spoke with a trade finance head at a mid-sized European bank last year. He told me, and I'm paraphrasing, we turned down 3 deals in Q3 that we would have approved 2 years ago. The credit was fine, the ESG wasn't, and our risk committee wouldn't sign off. 3 deals, 1 quarter, 1 bank. Multiply that across the industry and you start to see the scale of what's happening. And it's not just the banks driving this. They're institutional investors, they're regulators, they're reinsurance counterparties. Everyone in the chain is asking the same question. What's the ESG profile of your trade finance portfolio? Now here's where it gets really difficult. And this is the part that frustrates trade finance teams the most, because they're being asked to do something they don't have the tools to do. ESG data is a mess. Let me be specific about why. First, it's fragmented. There's no single source of ESG data. You've got Sustainalytics, MSCI, CDP, Bloomberg ESG, S&P Global, Moody's ESG, and they all use different methodologies, different weightings, different scoring scales. A company can score A with one provider and C plus with another. Same company, same year, different rating. Second, it's inconsistent across jurisdictions. The EU has one set of taxonomy standards. Southeast Asia has emerging frameworks through ASEAN guidelines. The US has no federal ESG disclosure mandate, though the SEC's climate disclosure rules are evolving. So depending on where your supply chain operates, the available data varies dramatically in quality and scope. Third, and this is the biggest problem, most ESG data is self-reported. Companies fill out sustainability questionnaires. They publish their own ESG reports. They select which metrics to highlight and which to omit. There's limited third-party verification for most of it. You're essentially trusting the borrower to grade their own homework. Now layer that onto trade finance. You're not just assessing one company, you're assessing a supply chain. That means dozens, sometimes hundreds, of suppliers across multiple geographies, multiple industries, multiple regulatory regimes. And you need to form an ESG view on the entire chain, not just the borrower sitting in front of you. Trade finance teams are used to assessing credit risk. They have decades of tools, models, and data for that. But ESG risk, they're being asked to score something they can barely measure, with data that's fragmented, self-reported, and inconsistent. It's like being told to take a final exam, but nobody gave you the textbook. Half the questions are in a different language, and the answer key doesn't exist yet. And the regulators aren't waiting for perfect data. The European Central Bank's supervisory expectations on ESG already require banks to integrate sustainability risk into their credit processes. The Bank of England's climate stress tests require scenario analysis that depends on supply chain emission data. These requirements are live, today, with imperfect data. That's the tension. Regulators want ESG integration now. The data infrastructure isn't there yet, and trade finance teams are caught in the middle. So given all of that, the regulatory pressure, the deal-killing power of ESG, and the data chaos, what are the smartest trade finance teams actually doing? Because some teams are getting ahead of this, and the gap between them and everyone else is widening fast. First, automated ESG data aggregation from multiple sources. They're not relying on a single provider, they're pulling from Sustainalytics, MSCI, CDP, and proprietary sources, and cross-referencing. Where ratings diverge, they flag it for review instead of picking the most convenient number. Aggregation doesn't solve the inconsistency problem, but it gives you a more complete picture than any single source. Second, risk classification at the supplier level. Red, amber, green, simple. Every supplier in the chain gets a tier. Red means the deal is at risk until remediated. Amber means additional due diligence required. Green means proceed. This isn't sophisticated modeling, it's practical triage that lets trade finance teams prioritize their effort on the highest risk nodes in the supply chain. Third, and this is critical, continuous monitoring, not annual reviews. ESG risk is dynamic. A supplier that was green 6 months ago can turn red after a regulatory violation, an environmental incident, or a change in sourcing practices. Annual ESG reviews are already outdated the day you file them. The teams that are ahead are running automated monitoring that flags changes in real time. News alerts, regulatory filings, NGO reports, satellite data for environmental compliance. Fourth, integration with trade finance deal flow. ESG risk assessment can't be a separate work stream that happens after the deal is structured. It needs to be embedded in the deal screening process from day one. Before you spend 2 weeks on credit analysis, you should know whether the ESG profile is a go or a no-go. That saves time, avoids late-stage deal failures, and gives you a defensible process for your risk committee. The teams doing all 4 of these things aren't just compliant. They're faster. They're declining bad deals earlier and approving good deals with confidence. And they're building the kind of audit trail that makes regulators comfortable. As the ESG risk in trade finance is not a trend, it's a structural shift in how deals get approved or killed. I'm building FluxForce because risk intelligence shouldn't stop at credit and fraud. We started with fraud detection. Aiden Flux is production ready. ESG risk monitoring across supply chains is on the product roadmap. If you run trade finance risk and you're struggling with fragmented ESG data, single source ratings, or annual questionnaires that are outdated the day you file them, I want to hear how you're handling it. That conversation shapes what I build next. Link in the description. I'll see you in the next one.